Hello everyone, this is Sunanda Jha from Lavan Investing, and today we have virtually gathered here to discuss on the ongoing topic of climate change. And for that, we have with us Vijay Raj, who is the portfolio manager from Lavan Investing. He will be sharing his thought on the particular topic, along with different investment managers who will be further enlightening us with their thoughts and making the session more enriching one.
Yeah, I think let's get going. I think, Max, thank you very much. And thank you all. I think good morning, everybody. It's beautiful weather in Sydney and we are out of the lockdown. So that's a good news. And thanks, Chai, during the weekend, Max and Zach, we did talk on a lot of good economic subjects. And I think fantastic. But the news were of the Chinese and energy crisis and those things. Max, what do you say?
Oh, look, this is the topic of the day. I mean, there's big news coming out of China every week at the moment. We've gone through the Evergrande property, still going through it, that fiasco. And then there's energy crisis, which is not just China specific, it's Europe specific. But as you will talk about in this presentation, I think it's a pan-European Asian crisis that's unfolding at the moment. So yeah, very much.
Yes, I think. Yes, I agree with you. I think it's amazing news. I can't believe in the 21st century we suddenly coming across with like a blackout. I read in the newspaper in the morning. The UK ones, they said we might have the blackouts and same as in going on in China. And then that was in the news in India as well. And
That's
then Lebanon was out in blackout as well.
It's unbelievable in this day and age, isn't it? But it's happening in the first world countries. And hopefully we can learn more about it through this presentation.
Yes, now Max, I think let's get going. Please, I think let's start the presentation. And to that, please, what is energy crisis and where are we? Okay, so let's talk about the history of what is energy. Energy is basically now we hear all the time of renewable energies. Actually, to be very honest, Max and Chai, I did my engineering and I was specializing in alternative energy resources. Can you believe in 1994?
Wow.
So I'm coming back to this topic after so many years.
After 70 years, yeah.
Yes. Slide, please. Yes. So, for the energy, in the whole industrial revolution, was meant for this whole coal was the basic energy sources, coal, gas, and oil. And if you look around the presentations across, then the maximum with this whole climate change coming across in last couple of decades across, and then we got the Kyoto protocols, and the major thing that came across into the world discussion onto the climate change and the usage of this fossil fuels. That was the major concepts going across, and I think we are having implications, Max, with regards to the Paris Agreement and the binding agreements coming across. So it's two different concepts going simultaneously, and the investments going into the renewable energy and investments going into this old fossil fuel things. So it's that demand and supply gap is happening across the world, and again then it's a pandemic scenario. So let's talk about in more detail as we go into the supply side. So now if you look around the energy consumption, please slide please. Thank you. Thanks, Shruti. So if you look around that energy consumption worldwide, so the China is the maximum consumption going on, then US and India. So the consumption is moving from as with the demographic changing happening in Europe, America, and the Asian countries are developing more faster. That we can see into the energy consumption area. So and simultaneously, as we look around to the phenomena of the fossil fuel usage, so mostly it's all coming from the two major countries. That China is far onto the highest producer of the world, and then and consumption as well, and same as US, and then the India coming up across. So India and China are the two major, where is maximum producing countries of the coal and energy as well, and the consumption as well. So we need to be looking around what's happening into that market, what is demand supply scenario for the energy, coal, and all the things. Next, please. So the question comes in, is it energy crisis? That's a crisis means I can see like this blackouts happening. So I mean, I don't know, but it is definitely a small short-term impact. And let's see about, before we go into more detail, let's see about the prices. That, like, this is October going on, and we're talking about July. So look around. If you've seen the slides around, then it's from 100 point, it goes to 600 times the natural gas prices in July, August, September, 4 months. I mean, unbelievable. I think, I don't know, it's what do you call this, speculative, or what is it? Then next, natural gas and China coal, the things as well, it's almost double the price of the international coal market. So this is a very
recording in progress.
Pulling effect coming in across, and the price is, there is completely supply demand somewhere. The scenario is not right, but there are a couple of things that are playing role, which we come across in the next slides. Okay, what are the issues? What are the advantages? Where the future is going? We will talk in detail in a couple of more slides. Yep. Thanks, Shruti. So the question is, what are the reasons for this crisis? What happened? So if I go to the first one, and then my colleague Pooja, we will talk in more detail a little bit onto that. So the first scenario is basically, last year was a pandemic, Corona was there, and the whole economy, like countries like India, were completely closed down for 2 months. And then couple of economies across, they were closed up. And the whole GDP across the world economy from the World Bank reports has come down to very negligible zero levels. And we see now again so much of population, 70 to 80% of the population get vaccinated across Europe, China, as Australia has been opened up as well in next 1 or 2 weeks. I mean, New South Wales and myself say Sydney is coming in from yesterday. So happy with that, and hope things will not, there will be no lockdown. I'm hoping so. So after that, there is a now sudden demand, because the demand has decreased, and now there is a sudden, all the factories and all the things sudden start up. So the production is not catching up with the supply. So the demand is very high, and the supply is in over here, lower scenario. So there is a sudden spikes in the price coming up. Pooja, you want to talk more into what is the decarbonization of the economy and emission tradings and rising of the pricing, please?
Yes, sure, Vijay. Thank you. Thank you for going through energy crisis and how carbonization happened. So, yeah, we'll start with decarbonizing supply. So, can we go to the next slide, please? Yeah. So, as Vijay mentioned on the previous slide, the tightening supply situation from a lack of future investment across the fossil fuels like gas, oil, and coal. So, this is a chart of capital expenditure by energy companies in the S&P Global 1200 Energy Index. Europe has been phasing out coal plants in recent years, limiting the opportunity for electricity producers to switch to coal when gas prices rise. So this is what we have seen. Record carbon prices have also made fuel swaps less attractive because coal emits more carbon dioxide when burnt. And the changing shareholder base of energy companies is another reason why there isn't enough future investment going into fossil fuels. The investors of energy companies are now focused on capital, not investing in US oil majors or US. It's actually the dividend funds. Can we have the next slide, please? So, yeah, this is another chart confirming the falling investment in fossil fuels such as oil and gas. So here the chart shows that the number of rigs erected to explore new oil and gas fuels packed some time ago. Actually, in the case of gas, the exploration peaked before the GFC in 2008, and oil exploration peaked in 2014. So, Vijay,
do you mean to say that there is no more investment, that the investment happens as the record plays the number of rigs and investments by the refineries and the big oil companies that happened in around 2015, and after that there are no more? There is no lot of money or investments going on to that track. That's what you mean in this chart?
Yes. Yes, that's exactly, yes. Yeah. So moving forward, I would like to ask, what are some examples of companies which are prioritizing capital returns in Australia? So can you emphasize on that, Vijay?
Yep, I think the Max, that's and Shai, we had that news as well. I think with regards to the BHP selling up their assets to the Woodside Petroleum.
Yeah,
Max,
yeah.
what is the signal?
Yeah, I mean that's a classic example of an Australian company that we know of, which is BHP. It's got oil and gas assets that of petroleum and gas assets that have traditionally contributed around 17% of its revenues. Not only it's been tapering its investment in that space in terms of new exploration, it's actually flogged off those assets to in this case, Woodside Petroleum, and sold off those assets altogether. So that's a major signal from a major, what used to be an energy company as well, in BHP, saying that they don't want to be in fossil fuels. So yeah, that's an example at home that we can see.
Yep. I think even I was reading up a couple of articles coming from Reliance as well. They're also coming with the zero emission trading and those things, coming with the hydrogen and those kinds of renewable energy as well. So I think the whole world is going to I think with the 2050 emission tradings, zero emission for Europe, then South Korea pledging up, and then Japan pledging up around by 2050, and China gearing up to the zero emission level by 2060. So that is a lot of game happening over there. I think that is a very good signal. And the electric cars happening by 2030 into a lot of countries. And this a lot of supply side and demand side, the things are playing up across what will be happening into the energy market. Yeah, Pooja,
that's a good point you mentioned that, Vijay, because on supply of traditional fossil fuel assets is definitely decreasing in terms of keeping up with demand. Yet demand is becoming ever increasing because there's so much intensification of energy demand. People have got their electric vehicles coming up that they will be recharging. There's internet of everything. There's so much electronics around them that needs energy to fire up, whether it's obviously air conditioning systems that are running off the grid, not so much on going forward, the solar panels coming in and battery systems, but there's still so much demand for energy, yet fossil fuels are declining. So where's the gap that's going to bridge that? And I think we'll find out in the next few slides. Renewables is the answer, but are they keeping up?
Yep, I agree. Thanks, Pooja.
Thanks, Max. Can we have the next slide, please? So yes, given there has been significant curve in the investment in fossil fuels in Europe over the past decade, there actually has not been near enough investment in renewable energies, fuel, as you can see in this chart. In reality, capital investment in renewable energy sources actually peaked in 2011 and has been trending down ever since, with an uptick since 2018. So the gap and supply has been opening up in recent years. So it became obvious when the recent and expected surge in demand is simply not going to be met, which is leading to power outages in some countries like China. Yeah.
Yep.
So yes, this is the La Nina impact 2021. Winter could be chilly. So the La Nina weather system is raising the risk of disrupting the balance of cold and warm air streams at the North Pole, which means cold air may push down this winter to Europe and Asia, bringing with the higher than usual winter chills and thus increase the demand for energy and heating. So this is another reason for gas prices rising. The more chilly, the electricity will be used more. So that's where this is being impacted.
Yep, no, absolutely. Because I think with the cold crisis, I think there will be more usage of the heating equipments and those things. Yeah, so there will be huge demand onto that area. So in coming months, the northern side, the cold impact will be a big impact on the prices. Yeah, agree.
Absolutely. Yes. So about the energy crisis, China, which we are already discussing, China is experiencing power shortages and blackouts. Demand for energy from post-pandemic economic activity is ahead of the supply. So basically, how the crisis in China actually played out. So Max, Vijay, would you like to go through that, like how the crisis in China actually played out?
Oh yeah, I think China is facing, as we talked about, and they are also putting up efforts onto the emission trading and the coming to zero levels by 2060. So in that is, and simultaneously with the increase into the power prices, the government is putting up the new regulations and those kinds of things that not to be increasing the power prices. So the companies are not producing enough power, and simultaneously the import of the coals, the prices are very high, as it doubled the prices. So the companies are expecting that the price will decrease instead. Also, that's the gap is playing across. So the companies in last 3 months or 4 months almost double the price. That is, I mean, even if I'm the purchase manager, I'll think, should I be buying or should not I be buying? So same as our normal human beings, so same thing. So there is a severe crisis across the now. There will be suddenly, now they realize, okay, so there will be little bit that 2-3 months or 6 months, we will be little bit that time gap, and then the production will increase and all the factors will come out. But yes, at the immediately effect, it will take another this quarter or couple of, already you can see that I think September figures of the factory outputs, it has been almost a decline, and it's one of the most slowest month of the factory output. So that is already the signal. But I think the overall growth rate, China will maintain, and it should be a healthy rate as compared. Yep.
Absolutely, Vijay, because this has begun to impact China's factory output, which has slowed, and GDP growth is slowing. So I agree. Yep. So the next slide is energy crisis India is building up. India's power companies have been running down their coal inventories and delaying their purchases as coal prices have soared. No one wants to buy coal at expensive prices and produce power at a loss. So blackouts are also a possibility which could slow India's economic growth.
You over here. So basically what happens is there are two clubs. So basically the gas power plant are very in the peak time, peak usage time. The gas power plants are already sources because they can be fired up in four hours. So that's so easy. So you need the supply demand coming up, and but now the problem is the price is 6 times. So nobody's going to pay you the price. So now the whole idea about gas power plant is not working, because now you have 6 times, even if it is just not working, because you're not going to get, you supply it, you produce it, but you're not going to get the money out of the power prices. So the gas power plants are not working. So that is the problem here coming up. So same is in India as well. So the gas power plants are there. The gas power plants are not working because the prices are 6 times higher. Where do you go? So this is going to take some little bit time, but yeah, let's see. I think the energy ministers across, and I think people are working in. So I think they will be able to sort out in another 1 or 2 months things. But yes, it is critical. So the more important, the gas power plants are not working. That is more critical in over here. Yeah, Pooja.
Yeah, exactly. So the question is, how long will this crisis last? So, yep, anyone?
Max, what's your opinion?
Well, I think, as you've been saying, Vijay, the ministers across, energy ministers and the governments are working pretty hard in China and India and other parts of the world, where they're talking to the outside suppliers for gas that goes into Europe, comes from Russia. So there's been political conversations going on between Russians, putting in more supply, and Russians want to build another number of X amount of gas pipelines, which don't really serve the long-term purpose of Europe trying to become carbon neutral. So there's political jostling going on. Then on the the coal side, China's been trying to wean itself off Australian imports of coal. But then now it's got a political situation where it's got to buy that coal to service domestic needs, because it just needs that domestic energy so badly. So I think eventually the control is in the politicians' hands. So I think it'll be worked out. But you've got obviously the cold coming through in the northern hemisphere through this freakish, the icy cold air jet streams coming from the North Pole between December and February. So demand is going to be high as well. So they're going to have to come up with a solution. I think in the end, we will get a solution, but it's probably going to play out to February next year. I see it.
No, I agree with that.
You know?
And Chai, what do you think about the inflation, and will that be a drag on the global growth? Chai.
I think China dropped down. I'm happy to take that. So I think.
Thanks, Max.
What's really hopefully you can hear me. What's really interesting about this really is that it's the unintended consequences, and this is something we've been talking about. In fact, it's a reason why we've held our positions in energy stocks. Is that no one really, no one sees the forest from the trees, and I think this is one of the critical parts about investing, and that you need to be able to see the forest from the trees. And this is an example. The energy crisis right now is an example of exactly that. And I'm not here to argue whether we should move to new energy, renewables energy, or whatnot. But it's got to be it's very important to understand that bridging from fossil fuels, old economy fuels to new fuels is going to take some time, and you're going to need a bridging gap. You can't just stop the energy supply from old dirty coal or dirty fuels in a matter of months or years and then expect renewables to take that up. So this unintended consequences is something we've been actually been talking about in various interviews and forums for some time now. And it's exactly playing it out like that. And so the other unintended consequences, what Vijay just asked about, is inflationary pressures. So now, before, when inflationary pressures were kind of interpreted as short-term, because obviously COVID limited the supply, it didn't disrupt supply. It limited the supply chains to get the products from factories to I guess, to the consumers. And eventually you would have thought that, supply chains open up and products start flowing through, services start flowing through, and then it'll be all transitory. So it was short-term inflation. But then you've got this other dynamic, this energy crisis now coming into play. And this may actually make inflation much more persistent than people expected, which is why you've seen bond yields spike recently, despite the very the dovish tone from central bankers, because they're not in a position to raise rates in an aggressive manner over the short to medium term, because they don't want to suppress this growth recovery. So to your question, Vijay, inflationary pressures may actually persist longer than the market is expecting, and you can see that through various metrics. That inflation expectations still haven't caught up, and they're starting to now catch up a little bit, going, well, we've got an energy crisis. Supply chains aren't really opening up as quickly as we expected. So this may persist, and this will put upward pressure on inflation. This will put upward pressure on the central banks to raise rates quicker. That's an environment where growth is still moderating. It's moderating from very high levels, but it's still moderating. So you've got this inflationary pressures coming through, which is pushing and urging, putting pressure on central banks to raise rates in an environment where growth is moderating. So you could see a tightening. Again, the unintended consequences that investors really, really need to focus on when they're analyzing asset and asset classes, what may happen from policies and monetary policies. They're really in a tight spot right now, in the central banks. So if they raise rates in a moderating growth environment, that means that leads to a tightening financial conditions. Just quickly, there's a question by Minson in the chat. Is it a good idea to buy coal shares?
Yes, that's exactly, I think, on the investment food. Well, very quickly would be great. Please. Thanks.
Yeah, just very quickly, you need to understand the individual coal companies by themselves. But let me just put this notion to you. Investing in the commodity is very different to investing in the equity that is leveraged to the economy, to the commodity. So I just give you a very good example. Oil prices, Brent oil is back up to $80 or above $80. The last time it was at this level, energy equity prices were 26% higher. So, now what that shows you is investors are still not convinced, and maybe it's that whole ESG concern that they still have on the long-term view. So, they're not still buying the long-term story. So you may be surprised, and same with coal, right? So specifically on coal on a long-term basis does have a limited, shelf life, if you want to put it that way. There may be periods where you need to be understanding of how coal may trade, and obviously this is one example how coal prices have jumped so much. But yeah, I think the important point right there is you got to understand which coal companies you're investing in, and similarly, you may not get the same uplift in coal equity prices as you do in the underlying commodity. So the answer really is, which you may not want to hear, that you have to be selective, and the outcome at the equity level, leverage to the commodity, may be very different. And like I said, last time energy prices were up, equity prices for energy stocks were 26% higher. They may still get there, but yeah, food for thought.
Yep, fantastic, Zach. That was brilliant idea from you. I think really appreciate. Now I think it was Pooja. That was a very, very brilliant idea, and Zach, thanks, and Max as well. Thanks for helping into that answers and all. Really brilliant. Now I think last week we were discussing, and I think we had a couple of advisors. We were talking about which income shares you should be having. And I was thinking across, and I discussed with Bunnings and Max and Zach and all the people. I said, which one we should have the best stocks? And now what is best? That is one of the most dangerous question on earth. But anyway, we discussed few of the things, and we came across Kai. Let's talk with Gaurav. Gaurav, you there, right?
Hi, can you hear me? Hi,
yes,
Vijay.
You got nice, beautiful face. Nice hairs, better than me, but I got better than you. Don't worry. Okay, now Gaurav, we're going to we discussed about two stocks. So the number one was basically we had Suncorp, and the second one you talk about the Bunnings Trust. I mean, West Farmers. I think.
Well,
just give us an idea. What is the dividend yield and why it is better? I think you give me a little bit idea that on the dividend yield coming across onto the Bunnings was around 4.9%, and the Suncorp is approximately with the yield coming across with the franking credits around 5.5 somewhere, So that was, I think, very, very good discussion. But I think in a snapshot, I think if you can help me a little bit more into both the stocks and why it is good to have for the income would be really brilliant, my friend. Back to you.
Sure. Oh, sure. Thank you, Vijay. So just before we touch on the stocks, let me just an overview of how we think about how we think about picking up companies for our Australian dividends opportunity model portfolio. So we seek to invest in quality Australian companies with defensive earnings, which can support growing dividend yield. And the strategy has done pretty well, which has outperformed the portfolio has outperformed its benchmark by about 171 basis points since inception, and about 516 basis points on a one-year basis to 31st August 2021.